Monday morning, February 2nd, 2026, 9:30 a.m. Eastern Standard Time. The opening bell rings on the New York Stock Exchange, and within seconds, every screen in every trading room across the world will display a number. That number will determine whether Friday's collapse was a correction or the beginning of something far worse. Right now, as markets remain closed, gold sits at $4,900 per ounce. Silver hovers near $95. Both metals suffered their worst single-day losses in decades just 48 hours ago. Gold fell 12%, silver plunged 36%, 3.4 trillion in value evaporated. Margin calls obliterated leveraged traders. Retail investors in India watched RWA 130,000 per kilogram vanish in hours. And the man responsible for triggering this collapse, Kevin Warsh, hasn't even taken his seat as Federal Reserve Chairman yet. This is not about politics, this is not about opinion, this is about mathematics, market structure, and what happens when liquidity disappears. The question facing every investor, every trader, every person holding precious metals right now is simple. When Asian markets open Sunday night at 6 p.m. EST, when European exchanges follow at 3 a.m., Monday when New York opens at 9:30 a.m., will prices gap down into further collapse, or will dip buyers step in for a relief rally? The answer to that question will be written in the order books, and the order books right now are thin. Very thin. Welcome to the flow of money. Let's establish what happened Friday before we can understand what happens Monday. At 2:17 p.m. Eastern Time, a headline crossed Bloomberg terminals. President Trump nominates Kevin Warsh as Federal Reserve Chairman. Within minutes, the dollar spiked. Treasury yields jumped. And gold, which had touched an all-time high of $5,594 just one day earlier, began to fall. Not gradually, violently. The move accelerated through the afternoon. By 3 p.m., gold had broken $5,200. By 3:30 p.m., it was through $5,000. Silver, which trades with higher volatility than gold, collapsed even faster. From Thursday's peak of $120.64 per ounce, silver fell to $78.53 by the close. That represents a 36% intraday decline, the largest in recorded history. The mechanics of the sell-off matter because they reveal the structure of Monday's risk. This was not organic selling by long-term holders deciding to take profits. This was forced liquidation. Margin calls triggered automatic selling. Stop-loss orders were hit, creating cascade effects. Algorithmic trading systems detected momentum shifts and piled on. And perhaps most importantly, options dealers were forced to sell futures contracts to hedge their gamma exposure as prices fell through key strike levels. The result was a liquidity vacuum. Buyers disappeared. Bid-ask spreads widened, and prices gapped lower with increasing velocity. By the time markets closed Friday, the technical damage was severe. Gold had broken every support level established during the January rally. The $5,300 level that held during mid-month volatility, gone. The $5,100 level that marked the previous consolidation zone, obliterated. Even the $5,000 psychological floor, which many analysts believed would provide strong support, barely slowed the descent. Silver's chart looked even worse. The $100 level, which represented a historic milestone and should have attracted buyers, failed to hold. The metal closed Friday at $95, and after-hours trading saw it dip as low as $92 before stabilizing. Now, with 48 hours of weekend uncertainty, the question becomes what happens when the machines turn back on. Market participants spent the weekend analyzing, positioning, making decisions. Institutional traders reviewed their portfolios. Hedge funds calculated their exposure. Retail investors, many of whom bought gold and silver near the highs, watched their accounts and wondered whether to cut losses or hold through the storm. The answer to Monday's direction depends on three factors. First, whether leveraged positions have been fully unwound. Second, whether physical buyers emerge to support prices. Third, whether the narrative around Warsh and the dollar continues to dominate, or whether other factors reassert themselves. Let's examine each factor systematically because understanding the mechanics determines whether Monday brings opportunity or disaster. Leverage in precious metals markets works differently than in equities. A trader can control $100,000 worth of gold futures with as little as $5,000 in margin, a 20-to-1 leverage ratio. When prices move favorably, gains are magnified, but when prices move against the position, losses accumulate rapidly. And when losses exceed the margin buffer, brokers issue margin calls. Pay up immediately or the position gets liquidated automatically. Friday's collapse triggered thousands of margin calls. Many traders could not meet them. Liquidations began, and each liquidation added selling pressure, which triggered more margin calls, which caused more liquidations. This feedback loop continued until prices had fallen far enough to exhaust the leveraged positions. But here's the critical question. Are they fully exhausted, or do more margin calls await Monday's open? The data suggests that not all positions have been closed. Trading volume in gold futures on Friday was heavy, but not at record levels. This implies that many traders held through the decline, hoping for a rebound. Those traders entered the weekend with underwater positions, reduced margin buffers, and a decision to make. If gold gaps lower Monday morning, breaching $4,800, the next wave of liquidations begins. These traders will be forced out, not by choice, but by brokerage risk management systems that automatically close positions to prevent further losses. The cascade could push gold down to 4,600, 4,500 or lower, depending on where the next layer of support exists. Silver faces the same dynamic, but with higher risk. Silver's margin requirements are lower relative to contract value, meaning more leverage is common. A silver trader who bought contracts at $110 with 10% margin is already sitting on significant losses at $95. If silver breaks $90 on Monday, those positions become untenable. Forced selling begins, prices gap lower, and the cycle repeats. This is the bearish case for Monday. It assumes that Friday's decline was not sufficient to clear all the weak hands, that leverage remains in the system, and that technical breaks will trigger further algorithmic selling. The bullish case for Monday requires a different mechanism. It requires physical buyers to step in at levels they perceive as attractive, and it requires the belief that Friday's move was an overreaction to a single headline, not a fundamental shift in market conditions. Physical buyers operate on longer time frames than leveraged speculators. They are not concerned with daily volatility. They buy gold and silver as stores of value, hedges against currency debasement, protection against systemic risk. For these buyers, price declines represent opportunity. Gold at $4,900 is cheaper than gold at $5,500. If the reasons for owning gold have not changed, the lower price is simply a better entry point. The question is whether enough physical buyers exist at these levels to absorb the potential selling. Historical precedent suggests they might. During the April 2013 gold crash, prices fell 25% over several weeks, but at the lows, physical demand surged. Coin dealers reported record sales, central banks increased purchases, and within months, gold had stabilized and begun a slow recovery. The same pattern occurred in March 2020 when gold briefly crashed during the COVID panic. Physical buyers emerged and prices recovered quickly. If this pattern repeats, Monday could see a relief rally. Gold might gap up to $5,100 or $5,200 as dip buyers step in. Silver could bounce back toward $105 or $110. The sell-off gets labeled as capitulation, the final flush that clears excess leverage and sets the stage for the next leg higher. But this outcome requires two conditions. First, the fundamental reasons for owning precious metals must remain intact. Second, the selling pressure from leveraged liquidations must not overwhelm the buying interest from physical accumulation. And this is where Kevin Warsh becomes the central variable in Monday's equation. Warsh is not yet the Federal Reserve Chairman. His nomination must be confirmed by the Senate. That process could take weeks or months. But the market is not waiting. The market is pricing in what Warsh represents. And what he represents is a shift away from easy money, away from quantitative easing, away from the assumption that the Federal Reserve will always support asset prices. Warsh has a record. During his previous tenure at the Fed, he was known as a hawk, someone concerned about inflation, about the integrity of the dollar, about the long-term consequences of excessive monetary stimulus. If confirmed, he is expected to maintain higher interest rates for longer, to resist political pressure for cuts, to prioritize currency stability over stock market gains. This matters for gold and silver because precious metals thrive in environments of currency weakness and low real interest rates. When the Fed keeps rates below inflation, holding gold makes sense. Gold doesn't pay interest, but neither does it lose purchasing power to inflation. When the Fed raises rates above inflation, the calculus changes. Now bonds and cash offer positive real returns and gold's opportunity cost increases. Friday's market reaction suggests that investors believe Warsh will deliver a stronger dollar and higher real rates. The dollar index spiked, treasury yields rose, and precious metals, which had been rallying on the assumption of continued dollar weakness, reversed violently. If this narrative holds through the weekend, Monday's open will reflect continued bearish sentiment. But narratives can shift, and there are reasons to question whether the Warsh effect will dominate. First, Warsh has not been confirmed. The nomination could face opposition. Even if confirmed, he does not take office until his predecessor's term ends. The actual policy impact is months away. Second, the fundamental drivers that pushed gold and silver higher in January have not disappeared. Geopolitical tensions remain elevated. The US captured Venezuelan President Maduro, raising fears of broader military interventions. Iran faces domestic unrest and external pressure. Trade wars continue. These factors create demand for safe havens regardless of who leads the Federal Reserve. Third, central banks continue to buy gold. While the pace has slowed recently, the trend remains intact. Central banks accumulated record amounts of gold over the past 3 years, diversifying away from dollar-heavy reserves. A temporary dip in prices could accelerate this buying. Fourth, the structural deficit in silver has not changed. Industrial demand from solar panels, electronics, and electric vehicles continues to grow. Supply remains constrained. While speculative froth drove silver above $120, the underlying fundamentals support prices well above historical averages. These factors argue that Friday's sell-off, while painful, was a short-term overreaction. And if that interpretation gains traction over the weekend, Monday could bring buyers, not sellers. The challenge is that market structure matters as much as fundamentals in the short term, and market structure right now is fragile. Liquidity, the ability to buy or sell without moving prices significantly, has deteriorated across precious metals markets. Banks and market makers, the institutions that traditionally provide liquidity, have reduced their risk appetite. Friday's volatility reinforced this caution. When prices can fall 12% in gold and 36% in silver in a single session, providing two-way markets becomes dangerous. A market maker quotes a bid and an offer, agreeing to buy at one price and sell at another. In normal conditions, the spread between bid and offer is tight, and the market maker earns small profits on volume. But in volatile conditions, that spread widens. And in extremely volatile conditions, market makers step away entirely, refusing to quote prices because the risk of loss exceeds the potential profit. Friday saw this dynamic. Bid-ask spreads in silver widen to levels not seen in years. At times, the difference between where a seller could sell and a buyer could buy reached several dollars per ounce. In a market that normally trades with spreads of a few cents, this represents a liquidity crisis. When Monday opens, if volatility remains elevated, liquidity will remain poor. And poor liquidity means that relatively small order flows can cause large price moves. A wave of selling from margin calls could push prices sharply lower even without massive volume. Conversely, a surge of physical buying could push prices sharply higher on modest flows. The market becomes a pendulum swinging between extremes rather than a stable mechanism for price discovery. This is the environment traders will face Monday morning. Not a normal market where buyers and sellers meet at equilibrium, but a stressed market where structure has been damaged and stability cannot be assumed. In this context, the opening minutes matter immensely. The first 15 minutes of trading from 9:30 a.m. to 9:45 a.m. Eastern will set the tone for the entire session. If gold gaps down at the open, breaking through $4,150 or $4,800, it signals that sellers remain in control. Stop-loss orders below $4,900 will be triggered. Algorithmic systems will detect downward momentum and join the selling, and prices could quickly test $4,700, $4,600 or lower before finding support. If gold gaps up at the open, reclaiming $5,000 or $5,100, it signals that buyers view Friday's levels as attractive. Short sellers who bet on further declines will scramble to cover, momentum traders will flip bullish, and prices could rally back toward $5,200 or $5,300 before resistance reasserts itself. Silver will mirror gold's direction but with exaggerated moves. A gold move of 2% will likely translate to a 4% or 5% move in silver. This leverage works both ways. It amplifies gains during rallies and magnifies losses during declines. For traders, this creates risk but also opportunity. The directional move will be clear quickly, and those positioned correctly will profit. Those positioned incorrectly will suffer. For long-term holders, the calculus is different. If the fundamental case for owning precious metals remains intact, short-term volatility is noise. A holder who bought gold at $4,200 in early January still has significant gains even after Friday's collapse. Selling into weakness locks in a lower profit but avoids the risk of further declines. Holding through volatility preserves exposure to any recovery but accepts the risk of deeper losses. The decision depends on conviction, and conviction depends on understanding what Monday's price action actually means. A gap down does not necessarily mean the bull market is over. It could simply mean that excessive leverage needed to be cleared before the next leg higher can begin. The 2013 gold crash saw prices fall 25%, yet gold eventually recovered and went on to make new highs years later. The March 2020 crash saw gold drop 12% in days, yet it rallied 40% over the following months. Short-term pain does not preclude long-term gain, but there is a difference between a healthy correction within a bull market and the early stages of a bear market, and distinguishing between the two requires looking beyond Monday's open to the broader structure of the market. If gold stabilizes above $4,800 and begins to build a base, it suggests Friday was capitulation. If gold breaks $4,800 and continues grinding lower over the following days and weeks, it suggests a deeper retracement is underway, potentially back toward $4,000 or lower. The same logic applies to silver. A hold above $90 would be constructive. A break below $85 would open the door to $70 or even $60. JP Morgan's commodity strategist Marko Kolanovic has publicly stated that silver could fall to $50. He views the rally above $100 as speculative mania, driven by momentum traders and meme stock mentality rather than fundamental value. If his analysis is correct, Monday's gap down would be just the beginning of a much larger decline. Others disagree. HSBC maintains that silver's structural deficit and industrial demand justify prices above $100. They view Friday's sell-off as a temporary shakeout that will ultimately attract long-term buyers. Standard Chartered recommends that investors use dips to accumulate gold toward a 6% portfolio allocation, suggesting confidence that the bull market remains intact. These conflicting views reflect genuine uncertainty, and uncertainty is the defining characteristic of Monday's open. No one knows what will happen. Not the institutional traders, not the hedge fund managers, not the central banks. The only certainty is that price will move, and that move will create winners and losers. What can be known is the framework for understanding Monday's action. If prices gap down and volatility remains elevated, the risk is further liquidation. If prices gap up and volatility subsides, the opportunity is a relief rally. If prices chop sideways in a wide range, the message is that bulls and bears are evenly matched and resolution will take time. Each of these outcomes leads to different strategies. A gap down favors waiting for stabilization before re-entering. A gap up favors taking partial profits if already long or missing the move if flat. A sideways chop favors patience and letting the market reveal its hand. But underlying all of this is a deeper question that Monday's price action cannot answer. The question of whether the global monetary system is approaching a turning point. For 3 years, gold and silver have rallied on the assumption that the dollar's dominance is eroding, that central banks are diversifying reserves, that inflation and debt will eventually force currency debasement. This thesis has been supported by central bank buying, by BRICS nations exploring gold-backed trade settlements, by persistent inflation, and by record government debt levels. Warsh's nomination challenges this thesis, at least in the short term. If the Fed under Warsh maintains a strong dollar policy, if real interest rates stay positive, if inflation remains contained, the urgency of owning precious metals diminishes, not permanently, but temporarily. And markets are always about the marginal buyer and seller, the investor on the fence deciding whether to allocate capital now or wait. If Monday's action suggests that the Warsh effect is real and lasting, marginal buyers will step away. And without new buyers, prices will drift lower or consolidate at best. If Monday's action suggests that the Warsh effect was overblown, that the fundamental drivers remain intact, marginal buyers will return, and their return could fuel a sharp recovery. This is why Monday matters. Not because it determines the ultimate destination of gold and silver prices. That destination will be determined by the trajectory of debt, the decisions of central banks, the evolution of geopolitics, the reality of currency debasement. Monday matters because it determines the near-term path, the tactical positioning, the risk management required to survive the volatility and remain positioned for the long-term outcome. There is a concept in markets called time arbitrage. It means that short-term traders and long-term holders are playing different games with different rules and different measures of success. Short-term traders care about Monday's gap, about the next 5% move, about weekly profits and losses. Long-term holders care about where gold and silver are in 5 years, about preserving purchasing power across decades, about wealth that survives currency resets and systemic failures. Neither approach is wrong. They are simply different strategies requiring different temperaments. But they converge on one point. Monday's open, while not determinative of the long-term outcome, will create near-term pain or profit. And in markets, pain and profit are not abstractions. They are account balances, retirement funds, the ability to meet obligations or the failure to do so. Preparation for Monday begins with clarity about what you own and why you own it. If gold and silver are speculative trades, if they were purchased with leverage, if the intention was to flip them for quick profits, then Monday's gap becomes critical. A wrong-footed position can lead to forced selling at the worst possible prices. If gold and silver are long-term holdings, if they represent a portion of wealth held outside the banking system, if the goal is protection rather than speculation, then Monday's gap is less relevant. Volatility becomes something to endure, not something to trade. But even long-term holders must ask whether the allocation is appropriate. A portfolio that is 50% precious metals faces more risk from Monday's potential gap down than a portfolio that is 5% precious metals. Position sizing determines whether volatility is manageable or catastrophic. The reality is that most people holding gold and silver right now fall somewhere between these extremes. They are not pure speculators, but they are also not indifferent to price. They bought with the belief that prices would rise, and Friday's collapse has shaken that belief. Monday's action will either restore confidence or destroy it, and confidence in markets is the invisible hand that moves billions of dollars. When confidence exists, buyers step in on dips. When confidence evaporates, holders become sellers. The shift from confidence to fear can happen in minutes. Friday demonstrated this. Thursday's close saw gold at 5394 and silver at 114. Confidence was high. Confidence. Analysts were revising price targets upward. Retail investors were entering the market, convinced they were early in a generational bull run. By Friday's close, that confidence had been replaced by doubt. Accounts were underwater. Margin calls had been issued, and the certainty of higher prices had been replaced by the possibility of lower ones. Monday will reveal whether that doubt hardens into capitulation or softens into opportunism. The difference between the two is often just a few dollars per ounce. If gold opens at $4,850, many holders will conclude that the worst is over and hold. If gold opens at $4,750, those same holders may panic and sell. The psychology of price is as important as the fundamentals, and psychology is shaped by recent experience. Friday's experience was traumatic for anyone long precious metals. The speed and magnitude of the decline created fear, and fear once established is hard to dislodge. It takes time, stability, and evidence that the selling is exhausted before buyers regain confidence. Monday will begin that process or extend the fear. There is one more factor that could influence Monday's open but remains difficult to quantify. Central bank intervention, not in the sense of price manipulation, but in the sense of large buyers stepping in to accumulate gold at lower prices. If China, Russia, or other central banks view $4,900 gold as attractive, their buying could provide a floor under prices. Central bank buying typically happens quietly, through gradual accumulation, rather than market orders that spike prices. But in times of stress, even quiet accumulation can stabilize markets. If Monday opens and prices begin to fall, but then find support and reverse, it could indicate that large institutional buyers are present. This would be constructive. It would suggest that Friday's levels have attracted real demand, not just speculative interest. The challenge is that central bank buying is reported with a lag. The market won't know in real time whether such buying is occurring. It will only be inferred from price action, a stubborn refusal to break below certain levels, a steady bid that absorbs selling pressure, a gradual recovery that occurs without obvious catalysts. These are the signs of institutional accumulation. And if they appear Monday, it changes the risk-reward equation. It suggests that while speculative froth has been cleared, fundamental demand remains intact. Conversely, if Monday opens and prices continue to fall with little resistance, it suggests that institutional buyers are not present, at least not at current levels. They may be waiting for lower prices, they may be reassessing their allocation strategies, or they may be focused on other priorities. Without their support, prices could fall further before finding equilibrium. This brings us to the final consideration. What should an individual investor do Sunday night and Monday morning? The answer depends on current positioning and risk tolerance. If already holding physical gold and silver with no leverage, do nothing. Watch Monday's open. See where prices settle. Make no emotional decisions based on the first hour of trading. The long-term case has not changed. If holding leverage positions, Sunday night is decision time. Either add margin to weather Monday's potential gap down, or exit before the open and accept the loss. There is no middle ground. Leverage in a volatile market is binary. You survive or you don't. If holding no position and considering entry Monday's first 30 minutes will tell you everything. A gap down below $4,800 in gold or $90 in silver means wait. The selling is not finished. A gap up above $5,000 in gold or $100 in silver means the opportunity has passed. The dip buyers already won. The truth is simple. Monday morning, 9:30 a.m. Eastern Time, the market will speak. Not through headlines, not through analysis, not through expert predictions, through price. And price is the only truth that matters. The metals will either hold or they will break. Buyers will either emerge or they will stay away. Confidence will either return or it will collapse further. By 10 a.m., you will know which world you are living in. A world where Friday was capitulation and the bull market resumes. Or a world where Friday was the beginning of something worse. The question is not what will happen Monday. The question is whether you are positioned to survive what happens. Because in markets, survival is not about being right. It is about still having capital when clarity finally arrives. 9:30 a.m. Monday. The bell rings, the screen updates, and your account balance changes. Are you ready?